Welcome. My name is Carmen Federico. This is the second video of a series in financial accounting. We're going to pick up where we left off last time, analyzing business transactions. Well, in this video, we're going to analyze business transactions using debits and credits. Then we're going to journalize these transactions, post them to a general ledger, and produce a preliminary trial balance. So what are debits and credits? Great question. I get all types of answers when I ask that question to my students. So what it boils down to, what debit means to an accountant simply means left. And what credit means to accountants simply means right. So debits mean left, credit means right. That's all it means. So if you can put your shoes on in the morning, you can do accounting, as long as you put your shoes on the correct feet. Anyway, so debits mean left, credit means right. That's all it means. So before we go further in the illustrations tonight, in this video, I'm just going to show you a PDF of where we are in the accounting cycle. So let me share my screen with you all. On my screen is the accounting cycle. So this accounting cycle, there's portions that are done every single month, and then there's a portion that's done annually. Well, so far, right now, what we've seen is analyzing business transactions. That's the first part of the accounting cycle, and that's done monthly. You analyze business transactions, then you journalize them, you record them in a journal, and then you post them to a general ledger, and then you prepare a preliminary trial balance. In this video, we're going to be going over analyzing the transactions using debits and credits, journalizing these transactions into the general journal, posting them to a ledger. We're going to use a T account for that, and I'll show you what that means in a bit, to produce a preliminary trial balance. In the next video that's coming after this, we will walk through the internal adjustment process. And after the internal adjustment process, we can produce our financial statements. And then at the end of the year, we do our closing entries, journalize closing entries, post these entries to the general ledger, and prepare a post-closing trial balance. So that's where we are in the scheme of things. We're analyzing business transactions, and we're going to focus on journalizing, posting, and preparing a preliminary trial balance. Okay, so simply debit means left, credit means right. That's all it means. So let's take a look at, I'm going to share my screen with you all and put up an Excel spreadsheet to illustrate using debits and credits as we analyze business transactions. So as you can see, I have an Excel spreadsheet on my screen, and assets on the left side of the equation, liabilities and stockholders' equity on the right side of the equation. Well, as we saw in the last video, an asset, cash is an asset, okay? And if we draw a line down the middle of this, we show something that's called a T account. Accountants use this very sophisticated tool called the T account. They have a left side and a right side. That's all it has. And over on, well, let's copy this and paste it in here. And we'll put a liability account, accounts payable. And then over here, we'll put some stockholders' equity accounts. I'm going to put 4 of them in here. I'll tell you why in a bit. Okay. We use dividends, common stock, expenses, and then revenue. So cash, what side of the account, what side of the equation is cash on? Cash is on the left side of the equation. So when cash increases go on the same side of the T account that the account falls in the equation. So cash is on the left side of our equation. So when cash increases, it goes on the left side. So let's say Susan Smith invested $20,000 in her business and she got common stock. So cash is coming into the company. So cash is an asset. It's increasing. So we look at what side of the equation assets are on. They're on the left side. So increases will go on the left side of the T account. So common stock is an equity account, and equity accounts are on the right side of our equation. When equity increases, it goes on the right side. So this common stock will be put on the right side or a credit. So we have one debit to cash and a credit to common stock, or a left to cash and a right to common stock. So I want to call your attention to a very important principle in accounting, that whenever you have a business transaction, you must have at least one left and one right, or one debit and one credit, because debits must always equal credits and left must always equal right. Okay? And as you can see, the left side of our equation also equals the right side of our equation. We've got 20,000 on the right, 20,000 on the left. We just so happen to have a left side balance and a right side balance. And that's perfect, which is supposed to have. So let's say now we bought, let's say we bought some equipment. I'm going to copy this T account, make another one down here and call this equipment. And we bought equipment for, let's say we bought equipment for $10,000 and we put it on account. Okay. So what happens? What type of an account is equipment? It's an asset. Is it increasing? Yes. So as the asset increases, you put the increase on the left side of the T account as a debit. And then what's going on over here on the right side? We have to have a right. Since we have our left, we need a right. We always have to have at least one left and one right for every business transaction. So accounts payable, if we put it on account, we didn't pay it with cash yet. So we put it on account. So accounts payable, we owe this money in a future date, that is increasing. So let's look at accounts payables on the right side of our equation. It's increasing, so increases go on the right side. So we have our left to equipment and our right to accounts payable. Okay. So then what happens if now we pay some of this liability? We owe this money, so let's say we pay half of it. Okay. So we pay $5,000 to pay off a portion of this liability. What happens? Well, paid means cash is flying out the door. So how do we show cash decreasing? So if we look at it, cash is on the left side of our equation. Increases are on the left side, since assets are on the left side. Decreases, you go opposite. So you put the decrease on the right side. So cash is decreasing by $5,000. Okay. So if you had a balance here, if you were recording a balance of the cash after this transaction, you would have a debit, of 20,000 minus a credit of 5,000. You have a $15,000 debit balance. Okay, so let's finish this transaction. So we have a right to cash. Cash is decreasing, so you go opposite. Okay, increases on the left, decreases on the right for cash, because cash is a left side account. It's an asset. So what happens? Payables going down. Well, increases go on the right side, decreases, you go opposite. So you put the $5,000 here as a decrease. Okay. So we have a balance here of liabilities of a $10,000 credit minus the $5,000 debit. We have $5,000 remaining to be paid. We had started out with 10,000. We paid off 5. We have 5,000 to go. You notice that the balance is on the right side of the T account because we're on the right side of the equation. So right side balance. You notice the assets all have a left side balance. Cash and equipment both have a left side balance. Okay. Let's say we paid $300 for some supplies to be used this right away, this week. We're going to use $300 worth of supplies. So we paid for that in cash. What's happening? Cash is going down. So we'll find a cash account, increases on the left, decreases on the right. So we put the $300 decrease on the right. So now our new balance is going to be $14,700. So we have our right to cash. Cash is decreasing. Now we have to have a left. if we know we have a right, we need, where's the left going to go? What do we have? Supplies expense, the cost of doing business. What do expenses do to equity? Expenses bring equity down. So since equity is on the right side of the equation, when equity decreases, you go on the left side. So that $300 is going to be debited or put to the left side of the T account for expenses. So we have our right to cash and our left to expenses. Okay. So let's say now we made we made a sale, or we earned some revenue for what we're in business to do, and we charged our client $2,000, and we get cash right away. Cash customer, beautiful customer, cash. So we get $2,000 of cash coming in. So we look at our asset account, cash. It's on the left side of our equation. Is it increasing? Yes. By how much? 2,000. So we put on the increase side. So now our cash balance has increased to $16,700. Again, it's simply our debits minus our credits. And so we have our left to cash. Where are we going to put the right? Well, we earn revenue. So we go over here to the revenue account. We put our right in here in revenue. Does that make sense that revenue is on the right? Well, what side of the equation is revenue on? It's an equity account, and it's on the right side of our equation. So increases go on the right side. And revenues increase equity. Expenses decrease equity. That's why they're on the left side of the T account. So we always debit expenses and we always credit revenues, because revenues increase equity, expenses decrease equity. And let's say we paid some dividends to ourselves at the end of the month. We're the only stockholder, so we pay ourselves $1,000 in dividends. Paid means cash is going out. So we identify the account cash. It's an asset. It's on the left side of the equation. When it's decreasing, go opposite. So the $1,000 is going on the right side. So now we have a balance of $15,700 for assets, for cash, excuse me. Now we have our right. We need a left. So we go over here, dividends. Dividends are going to go on the left. Why are dividends on the left? Well, first of all, if you know you have your right already, this has to be a left, because you can't put two rights in the same entry. It has to be, they have to offset each other, at least one left and one right. You could have multiple lefts and multiple rights, or multiple debits, multiple credits, but you have a minimum, you have to have at least one debit and one credit, one left and one right. So dividends are on the left side. Why is that? Because what do dividends do to equity? Dividends reduce equity. So anything that reduces equity goes on the left side. Increases on the right, decreases on the left. When owners invest money into the business, that increases equity. When owners get money back as a reward, in terms of dividends, that is decreasing their equity. Okay, so increases when they invest money in, decreases the equity when they take money out in terms of dividends. Okay. So that's a little caption or scenario of how we use debits and credits to analyze business transactions using the accounting equation. All right, I'm going to stop sharing my screen for a sec. Okay, so we're going to walk through an illustration next, and I'm going to put this up on my screen in a minute. So we're going to take a series of transactions for the first month of operations for this particular company. We're going to record these business transactions in a journal, the general journal. Then we're going to take these transactions, post them to the general ledger, which we use T accounts to express the general ledger. And then we will end our summarizing of all the activity in the trial balance, a preliminary trial balance. So let me call up a spreadsheet right here. You call it up and take a look at it. Let's see right here. Okay, just see it up on the screen. We have, I'll make it a little bigger so you can see it. We have a series of transactions for North Company. North Company had the following transactions in its first month of operations in October. They open up a business account with a deposit of $40,000 in exchange for issuing common stock. And I just label these A, B, C, D, E, F, G, H, I instead of October 3rd, 4th, 5th, whatever. I just made it A through I for simplicity's sake. But normally these would have dates. Okay. So then they paid the monthly truck rental, they bought some supplies, they paid balance on the supplies, they received some commissions for what they're in business to do. They paid office salaries, they paid the gas and oil for the truck, they paid some advertising, they paid dividends of $1,500. So what we're going to do, we're going to take these transactions, we're going to journalize them in the general journal below. We'll see that in a bit. We're going to then post these transactions to the general ledger, prepare a trial balance, and then we'll answer a couple of questions at the end. So let's get started. So first of all, we opened a business bank account with a deposit of $40,000 in exchange for issued common stock. Okay. So what's happening here? Cash is coming in. What type of account is cash? Cash is an asset, correct? So we are going to find the account called cash. And since cash is increasing, it's going to be a debit. So we're going to put it on the debit side of this general journal. Okay, just think of the general journal as just one giant T account. Okay, we have to think of this as one giant T account with lefts and rights, lefts and rights. So we're putting our increases on the left and our decreases on the right for cash. Okay, so cash is increasing on the left as we open that bank account, put $40,000 in common stock. So now we have common stock. Let's find that account, common stock, and that is increasing, and increases for stock, common stock go on the right because common stock is an equity account. Equity is on the right side of our equation, increases go on the right side or credit side. I could replace the words debit and credit with left and right, and it being the same thing. Okay. So let's keep going. Let's look at the next one. Part B, or item B. We pay the monthly truck rental charge of $4,800. Okay. So paid, what does paid mean? Cash is leaving the building. Okay. So we can do that part first. Cash, let's find the cash account. Since cash is decreasing, it's going to go on the decreasing side, the opposite side. Again, increases on the left, decreases on the right. So cash is decreasing, so we put the $4,800 decrease to cash on the right side. The question is, where do we put the left side of this entry? What account? Well, what is it? It's monthly truck rental charge. Do we have an account for rent? Yes, we do. It's rental expense. Let's find it. Rent expense right here. Okay, it's a cost of doing business. So we debit rent expense. Expenses are always debited. Why? Because expenses always decrease equity. Equity is a right side, on the right side of the equation. So expenses are decreasing equity, so they have to be put on the left side of the T account or in the journal. Okay, so it'll be debited, and the cash again is going down. So let's look at part C. Part C says we bought $2,150 of supplies on account to be used next month. Okay, so we're buying some supplies. We're going to use them next month. So they're an asset. They're an asset until we use them. Once we use up the asset, it becomes an expense. We'll find out about that when we do our adjusting entries in our next video. So let's take a look. So we bought $2,150 of supplies on account. Didn't pay for them yet, so we owe somebody money. So first of all, the supplies is an asset. So we find that account, supplies, and they're increasing. So they go on the increase side, which is the debit side, $2,150 a debit to supplies. And how do we pay for them? We didn't pay for them yet. We have an accounts payable. We're going to owe that money. We do owe that money. We're going to pay for it at a later date. And payable is increasing. So it goes on the increasing side for a liability, because liabilities on the right side of our equation, increases go on the right side. So we're going to credit or write the accounts payable for $2,150. So we debit the supplies for what we bought, the asset, and we credit the liability. Okay, so I hope this is all clicking and making sense. Let's keep going. Accounting is fun. Let's look at part D. We paid entry D. We paid $1,100 of the balance due on the purchased supply. So we paid some of these supplies off with the balance. We paid $1,100 of the balance due on the purchase supplies. Again, paid means cash is leaving the building. So we can do that side first. Cash is going out. So it goes on the going out side, which is the credit side. Again, cash comes in on the left. It goes out on the right. And if you can understand cash You got to understand 75% of the journal entries, because most of these journal entries revolve around cash, except for the internal adjustments we'll see next video do not involve cash. But most of your entries, your external business transactions, involve cash. So cash is leaving the building, so it goes on the credit side, the opposite side of its normal side on the accounting equation. And what do? D, we paid off, we paid off a balance due. So remember, we put the liability on the books on an entry C. Now that is coming off. $1,100 of that $2,150 is coming off. So if accounts payable increases on the right, it's going to decrease on the left. So we have to find accounts payable. That's the account, and it's going to show the decrease on the left. Why it decreases on the left? Because accounts payable is a right side entry. Right side account. It's on the right side of our equation, and decreases go on the opposite side of the normal side that account resides on. So if it's on the right side of our equation, you're going to put the decrease on the left, or as a debit. Okay, so increases on the right for accounts payable, decreases on the left. Let's look at transaction E. We paid the office salaries of $3,500. Paid. What does paid mean? Again, it means cash going out. So let's do that part first. Cash is leaving the building. So we can put that here in the credit. $3,500 cash leaving the building. Okay. Did I miss one? Yes, I did. Sorry about that. I missed transaction E. Sorry about that. Let's skip that and go back to transaction E. A little ahead of myself. Get excited. Accounting's so much fun. I get excited. I missed an entry. Entry E, received $18,750 of commissions from a cash customer. So we received money. So cash coming in. How do we show cash coming in? Cash is coming in on what side? What side of it's an asset account. What side of the equation is it on? It's on the left side of our equation. Increases go on the left side. So $18,750 on the left side. And what do? We earned something. We earned some commissions from a cash customer. So we find a revenue account here called, let's see what we have for revenue. Sales commissions, okay? And that's going to be $18,750 on the right side. Why? Because revenues increase equity, and revenues are part of the equity umbrella. So on the right side of our equation, increases go on the right side. So let's look at F. Now we can finally get to F, where we paid the office salaries of $3,500. Again, paid means cash is leaving the building. So cash leaving the building, $3,500. And we pay the office salaries. So we find an expense for that. Office salaries expense, $3,500. And again, expenses are always on the left side, as rent expense was on the left side as a debit. Salaries expense are on the left side as a debit. Why? Because expenses decrease equity. Revenues increase equity, expenses decrease equity. Let's look at transaction G. We paid for the gas and oil on the truck of $1,580 and miscellaneous expenses of $800. So we're going to put this in one entry here for G, and this is known as a compound entry. Compound entry. You can impress your friends this weekend at a party if you can explain to them what compound entry. Anyway, compound entry is just simply you have more than two lines. You have three lines here. Okay. So what do we have? We've got cash is leaving the building. How much cash? We paid $1,580 plus $800. That's $2,380 of cash leaving the building. So we can put that in here first. The $1,800 plus the $1,580. We'll put in $1,580 plus $800. So it's $2,380. Okay. And we have two different types of expenses. One is miscellaneous expense. And that was for how much? $800. And then we have, what was the other one? It was vehicle expense, gasoline expense, automobile expense. Let's see what we have here. For an account, we have automobile expense, $1,580. So there's your entry. We have debits, $2,380 worth of debits, and cash of $2,380 going out. Okay. Let's look at transaction H. H, we paid the advertising for the month of $1,300. paid $1,300 of advertising for the month. So what does the word paid mean? It means, again, cash leaving the building. Cash is an asset account. Assets, when they decrease, go on the right side, decreases on the right side. And that was for $1,300 cash going out. And what was it again? It was for advertising. So we need to find an advertising expense account. So we find that here, advertising expense, and expense goes on the left. And let's say you had a brain cramp. It's like, oh, I'm not getting this. I'm struggling with this. Well, if you can remember that every entry must have at least one left and one right, and you can nail down cash. You got cash down. You know, cash increases on the left, it decreases on the right. Well, if you can figure that out, that's going to help you solve the other part of the entry. You know that if cash is decreasing, it goes on the right side. So by default, this other $1,300 has to be a debit, has to be on the left side. Okay, so that might help you when you get stuck. Okay, so and let's look at the last transaction. We paid dividends of $1,500, transaction I. Okay, so paid again means cash is leaving the building. Cash leaving the building, $1,500, and we paid dividends of $1,500. And dividends are an equity account. And remember, dividends decrease equity. That's why they're on the left side or a debit. Okay, so anything that decreases equity is going to be a debit. Anything that increases equity will be a credit, right? It'll be a right because equity is on the right side of the equation. Okay, so we just journalized all this activity for the month of October for the North Company. That's what journalizing is. We're recording them now, the original book of entry, recording all these transactions in our general journal. But it doesn't just end there, because now we have to take these journal entries and post them to our ledger. The general ledger is the way to summarize all this activity, because it's one thing to record the entries, it's another thing to summarize them. It really doesn't do you a whole lot of good if you don't keep score. That's what accountants like to do. They like to keep score. But as I mentioned in my first video, if you remember, this is the most difficult part about accounting. It's right here. The journalizing, the analyzing and journalizing. Once you get that down, analyzing and journalizing, the rest should be pretty smooth, because now you're just taking all this hard work that you just journalized and you're simply posting it into your ledger. So let's take a look at the first one. So we're going to take a look at this one here. We're going to post this $40,000 debit to cash. So we find a cash account, and it's transaction A, $40,000. We post the debit. Okay, so we took care of that one. Okay. Now we go to this one, common stock. We're going to post that credit of $40,000 to the common stock account. So we find a common stock account right here, transaction A, and we put the $40,000 in the account. Okay, so all we're doing is posting what we see. If you see a debit, you post a debit. If you see a credit, you post a credit. I can't tell you how many students, for some reason, want to make this more complicated than it really is, and they sometimes reverse. They'll post a credit to cash and a debit to common stock for whatever reason. No, if you see, what you see is what you post. If you see a debit, you post the debit. So let's look at the next one, rent expense, $4,800. Let's find that account for transaction B, rent expense, $4,800, transaction B. So let's put that in here, $4,800. Okay. And then we find the other part of it is cash going down, $4,800. We find the cash account. And transaction B, we'll put the $4,800 as a reduction in cash. Again, increases. You don't have to put a negative 4,800. You don't do that. Just put 4,800. Just because it's in the right side of this T account, we know it's a reduction in cash. Okay. So let's look at the next one. Transaction C, we have a debit to supplies and a credit to accounts payable. So let's find those accounts. So supplies, transaction C, we're going to post that debit of $2,150 and find accounts payable. Transaction C, we'll post the $2,150 to accounts payable. Okay. So far, so good. Now let's go to transaction D. We're going to post the accounts payable debit and a cash credit. So find accounts payable. Accounts payable is going down. So we put it on the going down side where we journalized. Okay. And we post the credit to cash, the reduction in cash, $1,100, as we paid off that liability that we journalized up above. Now, transaction E, we have a debit to cash of $18,750 and a credit to sales commissions of $18,750. Let's go find those accounts. And E, transaction E, $18,750 was a debit to cash. And transaction E for $18,750 was a credit to sales commission. So we have a debit to cash and credit to sales commissions posted from what we journalized. Transaction F, we have the office supplies expense, $3,500, debit and cash credit. So let's find that. Transaction F, office supplies expense. We've got $3,500, post that debit. Find the cash account, post the credit. Okay, now we go up to transaction G. We have these multiple, this compound entry. So we have these two accounts. We have post miscellaneous expense and automobile expense and the cash. So since the cash is right here, let's post that. It's right G of $2,380 credit. And let's find miscellaneous and automobile expense and post the numbers here. So let's see. Transaction G, miscellaneous expense was $800. And then what was the other one? It was automobile expense, $1,580. So find that. Whoops. $1,580 to automobile expense. And then lastly, we have two more entries. Advertising expense, let's post this one. Transaction H, cash is going down by $1,300. And we post the advertising expense for $1,300 here. Okay, these are just references. I'm just referencing the journal entries. In real life, you'd have dates here, whatever dates they were in your general ledger showing when that journal entry was recorded. Now, lastly, we have dividends and cash. So we're going to post transaction I for how much was that? That was $1,500 right here. Post that credit and the dividends. We're going to post that debit. Find a dividend account. Transaction I, $1,500. Okay. So we're moving along. Now what we need to do is find total up all our balances. So for cash, we're going to take our debits and subtract. Whoops. And subtract all our credits. Well, can't see it there, so it's blocked. Okay, so we have $44,170. That's our debits minus all our credits. That's our ending balance. You notice it's a left side balance. Why? Cash is a left side account, so it'd have a left side or a debit balance. Okay. Supplies, simply $2,150. Accounts payable, we take our credit of $2,150 minus our debit of $1,100. So our ending balance is $1,050. The $2,150 minus $1,100. Common stock, that's it. Only one entry. That's our balance. Dividends the same. All the rest just have one entry. So there's really nothing to total up. Okay. We didn't even need a total for supplies, but we did it anyway. So now what we do, the final part, this is the final part of the video in terms of our accounting cycle, is once we've posted all our entries into our ledger, we just grab all these balances and produce our preliminary trial balance. That's what's a trial balance. So this should be one of the easiest things you do. You simply just grab the balances from your trial balance. Okay, so cash at $44,170, supplies has a balance of $2,150, accounts payable has a credit balance of $1,050, common stock has a credit balance of $40,000, dividends has a debit balance, debit balance of $1,500, sales commissions, that has a credit balance of $18,750. And we have rent expense, that is a debit balance of $4,800. Office salaries expense has a debit balance of $3,500. Automobile expense has a debit balance of $1,580. Advertising expense has a debit balance of $1,300, and miscellaneous expense has a debit balance of $800. Okay. You notice on our preliminary trial balance, our debits equal our credits. That's a beautiful thing. Does it mean we did everything correct? No, but at least we know our debits equal our credits. That's a good thing. We could have posted something in the wrong bucket. Maybe we posted cash as supplies and whatever. We could have made an error, but as long as our debits equal our credits, we know at least that balances. Okay, that's a good start, but it doesn't mean you might have put something. You might have posted this credit into whatever supply account by mistake or whatever. Okay. All right. So then that's it. That's the end of our summarizing. So we analyze, we journalize, and we summarize. That's what we get. And as our end of our summarization, we have our preliminary trial balance. Our next video will take off from this preliminary trial balance. We'll do some internal adjustments to get our all improved adjusted trial balance in our next video. Just below here, I want to call your attention to some statistics here, or some figures in accounting. Revenue minus expenses equals your net income. So what is the revenue for the period? Our revenue for the period is $18,750. Our expenses are going to be all our expense accounts, from rent expense on down to miscellaneous expense. That totals $11,980. So how much money did the company make? It's going to be our revenue minus our expenses. The company made $6,770 for the period. That was the amount of net income the company made. And then retained earnings. What is retained earnings? It's your net income less any dividends. So companies will retain their earnings, and then they'll reward their stockholders with dividends and take some money out of retained earnings. So what is it? It's our net income less our dividends. We paid out dividends of $1,500. So our retained earnings would be $5,270 at the end of October. Okay, again, it's our net income less our dividends. Okay, so I hope that helps you understand a little bit more about accounting. This was the analyzing using debits and credits, journalizing the business transactions, posting them to our journal ledger to get the preliminary trial balance. So stay tuned for the next video. We go over the adjusting process in our accounting cycle. That's it for now. Accounting is fun. I'll see you next time.